Welcome to my channel for a discussion of the key financial ratios we should be looking at when analyzing a business. Let's understand what a ratio is. Ratio is just a relationship between two quantities. How much of one is in another. How the two are proportionally related. Say if there are 4 oranges and 6 apples, what is the ratio of apples to oranges? 6:4 or 3:2. What's the ratio of oranges to the total fruits? 4:10 or 2:5, which means for every 5 fruits, 2 are oranges. Ratio gives us an idea of one parameter in comparison to a similar or a parameter of interest. Let's take an example. School A is producing 300 brilliant students scoring above 80%. Okay, good. But what if I say the school has a total of 1800 students and is producing 300 brilliant students scoring above 80%? If I say last 5 years on an average the school produced 900 such students. If I say school B and C this year produced 1500 and 1600 such students with an average of 1200 such students over the last 5 years. Now, does the performance of school A look impressive? Not really. When we put forward a ratio, we get a sense of the school and its performance not as an absolute value but relative to its own other parameters or its own past or its peers, which is a great thing. On the same lines, analysts have calculated and put forward certain financial ratios for us to help us get an idea of a business performance in comparison with certain parameters of its own and thereby help us compare it against its own past performance or against its competitors. Now that we are convinced that ratios at least make some sense to us, let's broadly divide the ratios into certain heads. There are many ratios actually under each head, but I am covering only the very important ones. Profitability ratios tell us how good the company is in generating income relative to certain parameters, as we will see. The first important profitability ratio is gross profit margin. If you don't know what gross profit is, let's say the sales or revenue amount is 100,000 rupees. The cost of goods sold, that is, the cost associated with direct inputs of manufacturing the goods like raw materials, labor, come to 40,000 rupees. Sales minus COGS is gross profit. A ratio of gross profit to the net sales amount expressed as a percentage is a gross profit margin. Gross profit margin tells us how efficient the company is in managing its production costs, because production costs is what go into COGS. If you go a bit further, after the COGS come other expenses like administration, rent, salaries, sales and also depreciation, which come to say 20,000 rupees. What we are left with after deducting these costs is operating profit or EBIT. The ratio of operating profit to the sales amount expressed as a percentage is the operating profit margin, which is a fantastic way of assessing the company's business model when compared with its competitors. Likewise, we can also look at net profit margin, which is a ratio of the net profit to the sales, or operating cash flow margin, which is a ratio of the operating cash flow to the sales. Operating cash flow is the net cash generated by the company's normal day-to-day business operations. We have other ratios like return on assets, return on equity, and return on capital employed. Return on equity is a ratio of the net profit to the shareholders' equity. Remember what net profit is? Shareholders' equity is what belongs to the shareholders. Say for example, a company's assets are worth 100,000 rupees and its liabilities are worth 40,000 rupees. The shareholders' equity is So, if we divide the net profit the company is generating to the shareholders' equity, we get ROE. To put it simply, ROE is the money generated for each rupee of the shareholders. It tells us how good the company is in generating income versus the money shareholders put in. If you want to know more about ROE in a simple format, refer to my video. Return on capital employed is a ratio of the income to not just the shareholders' equity amount but also the liabilities amount. Meaning this ratio measures the income generated for the total capital employed by the company, barring the current liabilities. That means the short-term liabilities to be paid within 1 year are not taken into account. Only the long-term liabilities are considered. So in our example of the company having 100,000 rupees worth of assets and the long-term liabilities are 40,000 rupees, shareholders' equity is 60,000 rupees. We really don't have to bother which money is shareholders and which money is the liability money. All we need to consider is the total money invested in the business. That is the total capital. And that is 100,000 rupees. Coming to the numerator, in case of ROCE, we don't consider the net income. Instead, we consider the operating income which we discussed earlier in this video. So, ROCE is nothing but the operating income generated for each rupee of the capital employed by the company. Capital employed in crude terms is whatever investment the company made for its business. While ROE highlights the profitability from the view of investors only, ROCE tells the profitability of the overall business. That means the creditors who gave money to the company also have an interest in this ratio. Last and very important ratio in this category is the return on assets. Return on assets is the net profit the business is generating for each rupee worth of its assets. Don't you like it if a company generates more income using less assets? Now that we know what these terms are, let's put forward these ratios and compare with the ratios of its competitors. For each of these ratios, instead of taking the value for 1 year, let's consider for 5 years. The profitability ratios look good. In our next video, let's see how good the company is in meeting its debts, the short-term and long-term obligations. That means we are going to have a look at the liquidity and solvency ratios.